I want to talk Netflix stocks. So if we look at Netflix, recently they missed on subscriber estimates, yet they cracked down on passwords, which was meant to do the opposite. It was meant to increase subscribers to the platform. Guys, with Netflix, earnings have decreased, revenues have slowed down. Is there any hope left for Netflix stock? Let's dive a little bit deeper. I want to start by looking at the shorter term, what's happened in the short term. And after that, I want to look at the long term. What's happened over the past year and a half with Netflix stock? And is this a good stock to potentially hold into the future? So Netflix have released their new earnings report, and this was the findings that we saw in it. So this is Netflix's first quarter results compared to Wall Street estimates. Revenue came in at 8.16 billion versus the 8.18 billion expected. So they had lower than expected revenue. Earnings did a lot better, $2.88 per share versus $2.86 expected. But this is the problem. Subscriber estimates, subscribers came at 1.75 million versus 2.3 million net additions expected. So Wall Street analysts were expecting 2.3 million additional subscribers to Netflix. No. It was only 1.75 million. It says that Netflix newly released guidance for the second quarter for $2.84 earnings per share fell far short of street estimates of $3.07, while it declined to provide guidance for subscriber expectations for the first time. Whenever a company declines to give guidance on how many people are gonna be using their platform and how many more people may be using their platform, it's not a good sign. It often means that they don't really know what's gonna happen. They're a bit worried that it's gonna decrease. So they just say, okay, we're not gonna give guidance. Netflix rolled out several changes to its flagship service to address the surprise subscriber losses last year, launching a less expensive ad-supported membership tier in November and initiating measures to crack down on account sharing this spring. By the way, I do think it's quite a good idea that they've got this less expensive ad tier. So for people who can't afford to buy the more expensive Netflix package, they can just say, okay, I'll get the cheaper one and I'll have ads in the cheaper one. It's not the worst thing, and it's a nice little option for customers. Reed Hastings, the company's billionaire co-founder and longtime CEO, stepped down from his post in January. Never really like it when a long-term CEO steps down, because the guy who finds the company, the guy who's grown the company for the past however long that Reed Hastings has, it's really nice to have that guy as at the head of a business instead of a new guy who doesn't know the business as well and who doesn't have a proven track record. So it's not good news that Reed Hastings is stepping down. In a recent note, Bank of America analyst Jessica Reif Enrich estimated that actions will result in roughly 1.5 billion in added annual revenue for the company, calling the password crackdown an enormous long-term opportunity. So they've expected that this is going to bring in a whole lot more money into the company. The fact that they've cut down on password sharing, it hasn't done this in the short term. In the long term, they expect that it will do so. So guys, let's take a look at what's been happening to Netflix's price. Go on the Buffett Investors website. Netflix stock over here. We'll look at their price in the short term, and then I'll take a look at their price in the long term. So over the past 6 months, Netflix's price has kind of hovered around that $300 mark and gotten up to around $360. Right now, it's at $330. So it's been hovering around $300 to $360 per share. But now let's take a look at the long term, because this is where things get very interesting. In October 2021, the stock was selling for $690 a share. Right now, the price is only $330. So just a year and a half ago, it was selling for more than double the price. Things have gone down a lot over the past year and a half. Now, the big question is why? Why has Netflix gone down by so much in terms of price since October 2021? There's a couple of key reasons that we need to talk about. The first and obvious thing that you should look at when trying to work out why is the company's stock price down is to look at their fundamentals, is to look at the income statement. The income statement is very important. It's going to give you a lot of clues on what's going on. So let's take a look at total revenue. Total revenue, as you can see, up until the end of 2021, Netflix was just a revenue growth machine, a revenue producing machine. Every year, it looked like they were adding $4 billion to their revenue. See, 2017, $4 billion. 2018 to 2019, $5 billion. Then to 2020, $5 billion. Then another $4 billion up until 2021. And then end of 2021, things started to slow down in terms of revenue. And the next year, they only added $2 billion in revenue. So just remember that Netflix is a growth stock. So investors expect their revenue to grow at a high rate of clips. If this rate of clips decreases by more than half, do you think investors like this? No, they hate it, and this is one reason why the stock is down by so much. The other thing that we need to look at, one of the most important ingredients, one is revenue. What's the other one? Profit, earnings, net income. It's all the same thing. Net income for Netflix is even worse than their revenue. Let's take a look. So yeah, up until 2021, things were going amazing. They were just producing net income growth after net income growth. So went from 550 million to 1.21 billion to 1.8 billion to 2.7 billion to 5.1 billion. It's no wonder why the stock did so well up until that point. And then what do you think happened in 2022? It didn't look as good. It actually stopped growing and it did the opposite of growing. It went down. In 2022, it went from 5.1 billion to 4.5 billion. Now, do you think investors who are investing in a growth tech stock like Netflix, what do you think they feel? What do you think they think when the income stops growing at a high rate of clips? It doesn't actually grow by a less rate of clips, it actually goes down. Do you think investors like this one bit? No, they hate it, and this is why the price is down by so much. Guys, we don't need to complicate investing too much. Revenue, how much money in total a business is bringing in, is one of the most important ingredients. Profit, net income. This is another one of the most important ingredients. When revenue starts to slow, when income starts to go down, it's pretty obvious what's going to happen to the stock price, especially with a high growth tech stock like Netflix. Now, one of the most important bits of data, arguably the most important bits of data for Netflix stock, is how many people are subscribing to the platform. Now, I want to take a look at the longer term picture. We've talked about the shorter term picture on how they missed on short term expectations. Let's take a look at the longer term picture and what's been happening. Remember, subscribers to Netflix is how Netflix brings in revenue. So as we can see, it's a similar story just to their revenue picture in general. 2017, 2018, 2019, they were just piling on new users after new users. Different countries were subscribing to the platform. They were a high growth machine. But then, third quarter of 2021, things start to slow down. They start to mature. The Federal Reserve starts to raise interest rates. Money becomes harder to get a hold of. People have less money. What do when they have less money? They have to keep buying food. They have to keep buying energy and electricity. They still need to buy the essentials. But do they really need to keep their Netflix subscription? These are the types of questions they will ask themselves. And as we saw at the end of 2021, start of 2022, things started to mature, started to plateau, and Netflix stopped adding as much subscribers to their platform as much as they were doing before. And this is the reason why you see revenue maturing, because how do they get revenue? They get it through paid subscribers to the platform. When you're a stock that's priced to grow You want these subscribers to keep growing every year. When the growth slows, investors don't like this, and this is another reason why the stock is down in price. Now let's get into the fourth reason. The fourth reason is increased competition in the market. Now think about Netflix 10 years ago. They absolutely dominated the movie, TV series, streaming platform. They didn't really have much competition. All we knew was Netflix. But now, as time has matured and as the slow big companies have caught up, they too want a piece of this market share. And now Netflix have increased competition from not just small companies with no money, no. Big companies, mature companies with a lot of money to throw in and compete against Netflix. We've got Disney coming, who came in. When did Disney come in? You can answer that in the comment section below. Disney have come in and started competing with Disney Plus. Amazon Prime are competing against Netflix. Apple are competing against Netflix. Paramount, these big companies with a lot of money are now competing against Netflix, and this makes it a harder business to be in. An ideal business is a monopoly, kind of what Netflix had in a way 10 years ago, where the other businesses hadn't come in yet and started to compete. But now Netflix is no longer in a monopoly, duopoly type business. They're in a competitive market and they're not competing against these weak companies with no money. No. They're competing against these big companies, strong companies with almost unlimited amounts of money. This is not a nice place to be as a business owner. Remember, when you're a stockholder, when you own the stock, you are a business owner. Another great point that was made by Sven Carlin, the biggest value investor on YouTube, he said that everyone is now competing for attention. Even I'm competing in a way for your attention on YouTube. You know, everyone wants a piece of the viewer's attention. You know, Facebook, Instagram, everyone is looking for attention and your eyes to watch their screen. This is just such a competitive environment to be in for a company, and it's not my favorite business model, I gotta be honest with you. Remember that investors like monopolies, they like low competition. Customers like high competition, where businesses are competing against one another because they'll lower prices and up the quality of service. Customers love high competition. Consumers love high competition. Investors, business owners, hate competition. Another annoying thing about owning Netflix stock, just looking at it from a business point of view, is they have to put so much money into producing content and making content in the first place. This is why you don't see Netflix as a cash flow machine just giving out money back to the shareholder. No, they have to get money and they have to use this money to produce content. That's very annoying because it results in lower profit margins. Let's just take a look here. Look, 2.7 billion in research and development expense, 2.5 billion in selling and marketing, 1.5 billion in general and admin expenses. Very annoying as a business owner when you make all of this money, but with the money you can't actually keep it. You have to just put it back into the business. This is not a nice business. Now guys, I've said a lot of negatives about Netflix stock. I do want to give you one big positive that they still have, and that is the trend is people, you know, back in the day, let's say 15 years ago, we were all watching TV, right? And then slowly we realized that it was a lot easier just to watch the internet, just to watch like YouTube, watch Netflix, because you can watch what you want, when you want, at any time you want, where you want. It's so much easier to watch things on Netflix compared to watching TV. So this is one big tailwind that Netflix have in their favor, and that is people are still coming across from watching TV, watching cable, and they are bringing their attention to streaming and watching the likes of Netflix. So this trend is one big tailwind that Netflix still has in their favor. So it's not like they have everything against them. They do have some positives in their favor. Okay, I just want to take a look at what some other investors think about Netflix stock. Let's take a look at the king of all investors. Let's see what Jim Cramer has to say on Netflix stock.
I think the consumer all over is trying to figure out what they paid more for and what's a bargain. And I came away thinking, you know what, Netflix remains a bargain. I don't want to pull Netflix. Isn't it the moment that we're waiting, Dave, where we're all looking to say, I'm still willing to pay for that?
Yeah, I think a lot of consumers are trying to figure that out. I think a lot of them are overburdened by streaming services at this point. That said, one good show you want to watch will keep you paying the price.
Yeah, so they basically reiterate some of the points that I've been making. Yes, there's increased competition. The consumer is the one who has all of the options to choose from. There's so much competition. And Jim Cramer made the point that, okay, people still may keep their Netflix subscription. They still do offer some good shows. But I don't think it's a good thing when the conversation is reverting to if the consumer will keep Netflix as a subscription, as opposed to will Netflix be able to keep growing subscriptions at a high rate of clips. The conversation has kind of changed around Netflix stock, and I don't like it. Now let's take a look at what the Dean of Valuation, this is his name, this is what they call him. His full name is Aswath. I don't know how to say his last name. I won't say his last name. Let's see what he says on Netflix stock.
In fact, I hold 5 of the 6 Fangam stocks other than Netflix. I think that the entertainment business is in for a complete shakeup. It's not just Netflix. You see it with Netflix, you see it with Disney, you see it with Warner. The business is broken and needs to be fixed. And I'm not sure where the fix is going to come from. So until I get a better sense of how that business is going to play out, I think Netflix is off my list.
Okay, so unfortunately after that, the interviewer did not ask why he thinks the business is broken. Maybe he just thinks that there's just too much competition for a business like Netflix, and the consumer, it's very hard for the consumer to actually pick a platform to go with because there's so many options and they offer such different type of content. Maybe that's what he means when he says the business is broken. Interesting point there. Either way, he doesn't want to own the stock. The last thing I want to talk about is the valuation of Netflix stock, because no matter how bad a stock is, no matter how bad a business, there's always a price that I'd be willing to pay for a business. If a business is absolutely terrible and you said, Cooper, just give me $1 to own the entire business, most of the time I'm going to be saying yes, okay, I don't care how terrible it is, it's still worth a price. So let's try put a true value on Netflix stock, and let's do it the Warren Buffett way, where Warren Buffett says that the value of a stock is the present value of its future cash flows. Essentially, he means work out the future cash flows of the business, get the present value of those cash flows, and that's the true value of the stock. So to do this, I'm going to go to the Buffett Investors tool. Just go to www.buffettinvestors.com. Go to the Intrinsic Value section, and we're going to need to enter into a couple of ingredients here. So I'm going to do a 7-year forecast for Netflix stock. I'm going to forecast Netflix 7 years into the future. Their earnings, their free cash flow 7 years into the future. I'm going to put in a 10% discount rate because I want to get a 10% return on the stock that I buy. Minimum, I want to get a 10% return. Now, future growth rate. How much is earnings going to grow by in the future 7 years? That's a good question. So let's see revenue. Revenue has grown by 21% over the past 3 years, 25% 5 years, 25% 8 years, 24% 10 years. Okay, that's interesting. And what do analysts expect earnings to increase by in the future 5 years? 17% in 1 year, then year over year 26%, 25%, 15%, 17%. Okay, so I think a fair growth rate to put on Netflix will be 15%. I think that is somewhat conservative. So we're going to assume that Netflix grows their earnings by 15% in the future. We'll do a terminal PE of 20. 20 is a reasonable price to sell the business for, a reasonable multiple to sell the business for. Now, one thing that I do want to change is I want us to do the starting earnings in free cash flow. We're going to use the starting earnings in net income over here, which is $4.2 billion. In 2021, they made $5.1 billion. So let's just say $4.2 billion in income is a fair place to start our intrinsic value calculation from. So let's plug that in. $4.2 billion is our starting free cash flow or starting earnings. Now let's calculate what we get. So as you can see, we're going to start by saying in year one, we get 4.2 billion in free cash flow. And then every year it grows by 15%. Da-dun, da-dun, da-dun. And these are the cash flows that we're going to get from the business. Then in 7 years time, we're going to sell the business for this much. And those are our total cash flows that we'll get. This gives it an intrinsic value of $130 billion, which is still 11% below the current market cap. So the value is the calculated value based on these metrics here is actually below the current price, the current market cap of $146 billion. So right now, I still believe that Netflix is overvalued. If we look at their PE ratio, Netflix has a PE of 33. Now, do I want to pay a price that is 33 times higher than the current earnings of a business? Now, what do I get in return for that? Paying 33 times the current earnings, aka if earnings stay the same, it's going to take me 33 years to earn my money back. What do I get in return? I get Netflix, who's a business that's in a highly competitive space where competition is growing, where people are still wondering, should I hold on to my Netflix subscription? So should I sell it? The growth is less and less and less as it was before. For me, Netflix is not a high quality business, and I would not want to pay a 33 times multiple on Netflix stock. And that is just me, guys. If I do pay 33 times earnings, you best believe I better get a high growth business, a good quality business. For me, Netflix does not fit that mold.